Overnight, we've seen a nuanced picture emerge. Stock index futures are painting a resilient canvas, showing modest gains across the board. This suggests a cautious optimism, or perhaps simply a digestion of the latest economic data and the new Fed leadership. However, beneath the surface of these broad market moves, specific sectors and commodities are telling more dramatic stories. We'll delve into the why behind these shifts, exploring the implications for your portfolios and the broader economic narrative. The financial world is entering a new chapter, and understanding the subtext is paramount. The appointment of Kevin Warsh as Federal Reserve Chairman is undoubtedly the headline event, a development that is already shaping market sentiment. Mr. Warsh is known for his sharp intellect and a pragmatic, sometimes hawkish, approach to monetary policy. The context here is critical. Reports suggest that while some might expect presidential pressure for immediate rate cuts, Warsh has bigger plans. This indicates a potential for independent, data-driven decisions that prioritize long-term stability over short-term political expediency. His tenure could usher in an era defined by a more rigorous assessment of inflation and the willingness to maintain tighter financial conditions for longer if economic data warrants it. This stance contrasts sharply with what many had grown accustomed to, implying a less accommodative Fed than perhaps the market has become comfortable with. His perspective on financial regulation, often leaning towards deregulation, could also influence the broader financial sector. Meanwhile, in the crypto space, Michael Saylor continues to be a vocal proponent of Bitcoin, despite MicroStrategy facing significant headwinds. His unwavering conviction, even amidst questions about his firm's strategy in a volatile market, underscores a particular investment philosophy that is high conviction, high risk. This contrast between the cautious traditional financial institution and the bold, often audacious, digital asset evangelist is a defining characteristic of our current financial epoch. The bond market is often the earliest indicator of shifts in monetary policy expectations, and today is no exception. We're observing a pullback in the yield on the 10-year Treasury, a move that might seem counterintuitive given Warsh's potentially more hawkish leanings. However, this dip could reflect a complex interplay of factors: immediate investor reaction to the subtle nuances of his past statements, coupled with the latest macro data. The recent U.S. inflation figures, showing a moderation to 2.4% in January, provide a crucial backdrop. While inflation is cooling, it's not yet definitively at the Fed's target. Simultaneously, a stronger-than-expected jobs report has painted a picture of a robust labor market. This confluence of slowing inflation and strong employment creates a challenging puzzle for the new Fed chair. Will Warsh prioritize battling the lingering inflationary pressures, or will he acknowledge the softening price gains? The bond market's current posture suggests investors are still trying to price in this uncertainty, perhaps hedging against the possibility that Warsh, despite his hawkish reputation, will lean into the disinflationary trend if it persists. The underlying narrative here is that while the market is taking a breath, it's also bracing for a potentially more disciplined approach to interest rates, where data rather than anticipation drives policy. The spotlight is firmly on Kevin Warsh and his inaugural steps as Federal Reserve Chairman. His appointment signals a new chapter for monetary policy, and markets are keenly awaiting any indication of his specific strategy. While the broader market is still digesting his appointment, the overarching expectation is for a data-dependent, possibly less dovish Fed. This doesn't necessarily mean immediate aggressive hikes, but rather a more cautious stance on easing. We might see the Fed under Warsh prioritizing the long-term integrity of the dollar and aiming for a more normalized interest rate environment, moving away from the accommodative policies that defined previous eras. The next Federal Reserve meeting will be scrutinized for any subtle shifts in language, any deviation from past forward guidance that might signal Warsh's philosophical imprint. Across the Atlantic, central banks are grappling with similar, yet distinct, challenges. In Europe, the discussion around selecting the next ECB chief is gaining momentum, a process that could influence the Eurozone's monetary trajectory, especially as the current leadership's term draws to a close. There's a debate brewing about whether Europe needs to fast-track this selection, particularly amidst economic uncertainties and the political shadow cast by figures like Marine Le Pen on the succession. Meanwhile, the Bank of England is waiting for key UK inflation and jobs data, which will be crucial for their upcoming policy decisions. The common thread here is a global central banking community navigating persistent inflation, nuanced labor markets, and the ever-present geopolitical risks, all while maintaining a delicate balance between growth and price stability. Commodities are showcasing some of the most dramatic moves overnight, highlighting both geopolitical tensions and shifting demand dynamics. Let's begin with gold. The precious metal has had a captivating run, flirting with the monumental $5,000 psychological barrier, a level that would represent a significant milestone. Overnight, it's experienced a slight retraction, suggesting some profit-taking or perhaps a pause for reflection after its impressive ascent. The narrative here remains strong, however. Geopolitical instability, particularly in Eastern Europe where the post-war order is being questioned, continues to underpin its safe haven appeal. Investors are clearly diversifying into assets that traditionally perform well during times of uncertainty, and gold, with its historical luster, is a primary beneficiary. A test of the $5,000 mark indicates sustained investor demand, driven by both inflationary fears and a desire for stability in a turbulent world. Crude oil is also in focus, demonstrating modest gains, but the underlying story is one of renewed supply concerns. News that Hungary has requested assistance from Croatia after Russian oil flows via Ukraine were halted underscores the fragility of energy supply chains. Any disruption in this critical artery immediately tightens the market, reinforcing the price floor. The interconnectedness of global energy security means localized issues can quickly have a widespread impact. Conversely, natural gas is telling a completely different tale. We're seeing a significant drop, driven primarily by demand-side factors. Warmer weather forecasts across the US are reducing the anticipated need for heating, leading to an oversupply in storage. This immediate demand-supply imbalance is exerting downward pressure on prices. The volatility in natural gas continues to be a defining characteristic, often reacting sharply to seasonal weather patterns and inventory reports. These divergent paths in gold, oil, and natural gas perfectly illustrate the complex web of factors, from geopolitics to meteorology, that influence the commodities market. Overnight futures activity has given us a granular view of sector-specific sentiment. While the broader market indices are showing modest strength, individual giants in the technology space are experiencing a mixed bag of fortunes. Heavyweights like Apple, Nvidia, Microsoft, Amazon, Meta, and Google are largely facing some softness in their futures trading. This could be interpreted as a slight re-evaluation by investors after strong previous runs, or perhaps a cautious stance ahead of the US market open, especially with the new Fed leadership in place. The AI narrative, while still incredibly powerful, is undergoing a period of intense scrutiny. We've seen reports of Bill Ackman actively investing in AI stocks, signaling conviction from institutional players, yet individual tech giants are seeing some pressure. This isn't necessarily a bearish signal for the sector as a whole, but rather a sign that investors are becoming more discerning, differentiating between companies with clear AI integration and those potentially caught up in the broader hype. Tesla, on the other hand, is showing slight upward movement in futures. This could be due to specific company news or a general shift in investor perception, perhaps tied to renewed optimism around its innovation pipeline or market positioning in the EV space. It's a constant battle for investor attention and capital, and in this environment, differentiation and clear growth stories are paramount. The overarching theme in the sector watch remains one of cautious optimism, with investors closely watching for definitive signals from economic data and central bank policy under Kevin Warsh to guide their next moves. The digital asset space continues its fascinating dance between volatility and burgeoning mainstream acceptance. Bitcoin and Ethereum are both showing modest gains in overnight futures trading, reflecting a degree of stability after recent price fluctuations. This steady performance suggests that despite the broader macroeconomic uncertainties and the changing Federal Reserve leadership, a dedicated cohort of investors remains committed to the long-term potential of cryptocurrencies. However, the story of corporate involvement in crypto, particularly exemplified by MicroStrategy, offers a crucial counterpoint. MicroStrategy, a firm that has famously tied its treasury strategy to Bitcoin, is seeing a significant upward move in its shares overnight. This surge comes even as headlines indicate a turbulent period for the company, with reports of its leveraged ETP seeking a reverse stock split after a heavy fall, and questions arising about how its strategy would fare if Bitcoin prices were to drop significantly. This creates an intriguing paradox. The underlying asset shows stability, but the company whose fate is so intertwined with it faces considerable structural and strategic challenges. Michael Saylor, the CEO, remains a steadfast advocate, explaining how his firm's strategy is designed to endure even sharp market corrections. This highlights the high-conviction, high-risk approach inherent in such concentrated bets. For investors, MicroStrategy serves as a vivid case study in the risks and rewards of direct corporate exposure to highly volatile assets. It underscores the importance of understanding not just the asset itself, but the financial engineering and leverage employed by companies in this space. The crypto corner today is less about revolutionary gains and more about the ongoing maturation and the lessons learned from early adopters navigating unprecedented financial territory. As we look towards the US market open, the dominant theme will undoubtedly be the digestion of Kevin Warsh's appointment to the Federal Reserve chairmanship. Investors will be keenly analyzing every statement, every past interview, to infer his likely policy direction. The market will be searching for clues on how the Fed's stance on inflation, employment, and quantitative policy might evolve under his leadership. Beyond central bank speculation, the upcoming trading day will see continued scrutiny of economic data. While US CPI and jobs reports have offered recent insights, market participants will be watching for any further indicators that could sway the Fed's hand. Global economic reports, particularly from Europe and the UK regarding inflation and employment, will also draw attention, as they provide context for worldwide monetary policy trends. In the commodity markets, the ongoing geopolitical narrative in Eastern Europe will continue to influence oil prices, while weather forecasts will remain critical for natural gas. For individual equities, the tech sector will be closely watched to see if yesterday's softness persists or if buyers step in. Today is less about unexpected data releases and more about interpreting the signals from existing information through the new lens of Federal Reserve leadership.